Retiring on dividends is a great way to fund your golden years because it mitigates the sequence of returns risk. Instead of being subject to the gyrations of the market and wondering how that's going to impact your ability to meet your living expenses, you can simply kick back, relax, stay calm, and let the dividends flow, knowing that as long as your underlying dividends are stable and sustainable over time and ideally growing at a rate that meets or beats inflation, it doesn't matter what the market does today or tomorrow or even in the next year, because you're not looking to sell your stocks. You're actually just using the dividend cash flow, and ideally you're generating more dividends than you're needing to spend. So actually when the market declines, you actually can be excited about that, because that means suddenly dividend income went on sale and you can get even higher yields with the same amount of money invested, and therefore grow your dividend snowball faster than you otherwise would. That being said, dividend investing is far more challenging than it may look. It may look easy and just say, oh, let me just find the highest yield I can get and just go from there. But in reality, there are a lot of considerations you have to put in mind, especially when planning to retire on dividends, especially in today's chaotic world. And so in this video, I'm going to first discuss what philosophy I would use to craft a portfolio that I would retire on with dividends if I were to retire today. And then second, I'm going to list some specific names and how I would potentially craft a portfolio to retire with dividends. So it's going to be a little bit of a meaty video today, but you're going to get a lot of value out of it. So I hope you'll watch it to the end. Again, if you like this sort of content, please help me out and give this video a like. It would greatly aid in its distribution. Thank you so much. Okay, so what is the philosophy? What are the considerations I would keep in mind? Well, as you may have heard in some of my previous videos, I really look for 4 big qualities in dividend stocks that I look to buy, and I think it's even more important when looking to retire on dividends. The first one is it needs to have a durable and defensive business model. And by durable, I mean not just one that is built to last the test of time in the sense of like, okay, the company is being run for the long term or that it has a long track record, but I mean one that is built such that it can weather economic disruptions. Is it being threatened by the AI revolution or some other major technological or economic transition going on today? Or is it aligned with, or at least clearly sheltered from, these ongoing trends? So for example, during the e-commerce boom, if you bought a Class C or Class B mall REIT like CBL Properties, Washington Prime Group, or even Pennsylvania REIT, those were dirt cheap, traded at huge discounts to what analysts estimated were the private market value of their underlying assets. They traded at these huge dividend and cash flow yields. And so many piled into those stocks thinking, oh, these are dirt cheap. We can get rich buying these stocks that the market is over panicking about. Well, those companies ended up going bankrupt. And so if you are counting on those for dividend income, you probably crashed and burned pretty hard. In contrast, are you investing in a stock that maybe is leaning into the AI revolution? Maybe they're not a big name AI stock like Nvidia or Meta or Apple or Amazon or Palantir, but maybe they're an infrastructure provider, like maybe they build a lot of data centers, or maybe they're generating a lot of electric power in strategic locations and can get some contracts with some of these hyperscalers like Microsoft and Alphabet and Meta, et cetera, to help power their data centers, for example. And so you need to look at that as well. Then of course, on the defensive side, are they going to be able to generate sufficient cash flows throughout business cycles to support a dividend rather than being a highly cyclical company? Like for example, BXSL Industries is a stock that I have liked. I still think it's very undervalued, but it's not a great dividend stock for a retiree because it is a cyclical business. And so right now the business is going through a prolonged downturn. And so its earnings have dipped well below what its dividend is. And so the balance sheet is starting to get drained. And so management's soon going to have a choice to make if the downturn persists, which is an if. But if the downturn persists, the management's going to have to make a decision. Do I want to stretch my balance sheet more than I probably feel comfortable doing in order to sustain the dividend? Or am I going to cut the dividend in order to preserve the balance sheet? They'll probably err on the latter. Most management teams do. They preserve the balance sheet. They cut the dividend, but unfortunately for shareholders, in addition to reduced payout from dividends, usually the stock price crashes when that happens. And so that's one of the negatives of investing in a cyclical stock like that. You're taking a little bit more risk. And so again, if you're young, you're growing for maximal returns, you have a diversified portfolio, you can hold for the long term. That's okay. If it's a good company like BXSL, you can hold for the long term, it'll come back. But if you're a retiree who needs that dividend income today to live off of, you probably are not best off taking a gamble on a stock like that. Instead, you want to invest in one that is going to be able to deliver those dividends backed by stable cash flows and a strong balance sheet through thick and thin. For example, Realty Income is probably one of the clearest examples of one that you can just count on no matter what, because of just the defensiveness and the durability of the business model. Okay, then another big consideration obviously is what's my target yield going to be? And so you need to figure out what kind of yield do I want? People talk about the 4% rule, just liquidating your portfolio. Okay, if you want to live off dividends, you can do the 4% rule. That's a nice conservative estimate. I think today that's very manageable. It's less than what the 10-year treasury is yielding, and so that's very doable. Personally, I would go for a little bit higher in this environment because, again, the 10-year treasury is over 4%, and I think you can even get a higher yield on that if you have an intelligently diversified portfolio. You can handle a little bit of incremental risk, and so I think 6% is fair. I think too much higher than that over the course of a whole portfolio, you might be able to do it. You might even be able to sustain it if you're smart and you manage your portfolio properly, but you're probably not going to also grow at a rate that meets or beats inflation. And so I think 6%, and even if you want to err on the caution of 5%, but let's just say 6% for the sake of this video, especially if you say you have some Social Security you're going to be drawing, maybe you have some pensions or some annuities as well, or maybe you'll work part-time in retirement, who knows? So that, there are other forms of income, but I think 6% is fine. And then you can still generate some growth on top of that. Ideally, if you're getting a 10% annualized return, which I think most people can do, if you're smart about it, that gives you a nice 4% buffer to cover dividend cuts, to reinvest for growth, to offset inflation, etc. And of course, the final thing is, again, like I was mentioning, the growth and the coverage aspects of that dividend, making sure that it can grow over time and not just stay stagnant and get eroded by inflation, or certainly try to avoid painful cuts, at least in most circumstances. And of course, what factors into that there is what happens if a black swan scenario happens? What if COVID happens or something worse, 2008, 2009 financial crisis, or even worse than that? What if we go into a global depression? Like, let's say China invades Taiwan. There are many think tanks and economic modelers who said that will likely plunge the world into a depression, most specifically hurting the US and China the hardest. And so what would happen there? Well, you're probably going to see a lot of dividend cuts. You might see a lot of inflation too because of supply chain disruptions. Interest rates will likely be slashed to try to prop up markets and the economy. That could lead to inflation soaring even more. And so, especially if the US, for example, loses the war, even if they win the war, if they suffer enough losses that their ability to secure the global existing trade order and there's a shift in the balance of power across the world, that could also hurt the dollar, which in turn could lead to high inflation in the United States. So there are a lot of scenarios that could threaten the dollar. Obviously, we're not even talking yet about the debt that the U.S. has and the massive deficit spending that could eventually lead to high inflation and a dollar crisis. And so I think there are a lot of severe situations that could happen. Maybe the probability is not high, but it's high enough that I think, for example, an allocation to gold could make some sense as a hedge against that sort of thing, so that even in an event where the economy goes down the tubes, dividends are slashed, or even just their value is greatly reduced through inflation, you have something offsetting that, like gold, that can actually probably go up a lot in that sort of environment and can kind of carry you through until things get more stabilized, or even just give you more additional capital you can do to buy more dividends to offset what you just suffered. So that's one way to think about it. And so now that we've talked about these considerations, how would I put this portfolio together? Well, I would think about it really, the first 25%, I want to make sure that I'm getting a decent yield, so I'm not getting too far below my 6% target. I want to make sure that I have a good base of powerful dividend growth as well, and I want to make sure I have broad diversification. And I think there's no better fund than the Schwab US Dividend Equity ETF to meet that for this type of portfolio. And so I'd put about a quarter of my portfolio into SCHD. Why? It gives me a 4% yield, which is fairly close to 6%. I can offset that with some higher yields. Only charges 0.06% expense ratio, so low cost, highly efficient fund. Has over 100 blue chip dividend growth stocks, great diversification safety spread across a number of sectors, and it's grown its dividend at about an 11% CAGR over the past decade. So I know I'm getting that powerful dividend growth engine with that 1/4 of my portfolio. So what else am I going to do? I got to get that 4% yield up to reach my 6% target. Well, I'm going to put another quarter of my portfolio roughly in the midstream space, especially the MLP space. Now, a lot of these issue K1s. If you want to avoid the K1, I would just buy an ETF or two, or maybe a CEF, but ideally ETF because you don't have to deal with leverage there, like a Allocating MLP ETF, it's ticker symbol AMLP, or the Global X MLP ETF, that's MLPA. They both have dividend yields of nearly 8%. You don't have to deal with the K1 with those. And so that's another way to approach it. Personally, I like the K1s. They're more tax efficient. You don't have to pay the expense ratio. You can pick individual opportunities like Enterprise Products Partners, Western Midstream, Delek Logistics, Plains All American Energy Transfer, MPLX. There are many out there that I like. And on a weighted average basis, you can get probably about an 8% yield, dividend growth in the mid-single digits on average. And so you're going to get that inflation-beating growth and that high yield. And that combines with SCHD, 25% each. Combined, you're going to get about a 6% weighted average yield and dividend growth that should crush inflation. That's a great way to start your portfolio. And again, I like midstream so much because of the long duration contracted cash flows, makes it a very defensive business model. It's benefiting from the energy boom due to onshoring and the AI boom in the US. So it's a very durable business model right now. The yield is high, it's sustainable and likely to grow. So it meets all my requirements. So what am I going to do with the other half? Well, I'm going to put about 10% each in 5 different buckets. One is going to be gold that I just mentioned. There are a lot of different opportunities you can look for in gold, but my favorite is monetary metals. I have a link to it in the video description if you want to check it out. And what it is you can buy gold and silver at very, very slight, less than 1%, like so 0.75% premium to spot price. They store it for free. So that's way cheaper, by the way, than any premium you'd pay if you bought bullion anywhere else. And they store it for free. They don't charge you any storage fees. And if you choose to, you can lease it out and you can earn around a 4% yield on average. Leasing it out, these are very low risk yields. They've never had a default, never lost any principal, never missed any payments. I've been doing it for years now. Great results. So you can earn a yield on your gold along with owning the gold with free storage, and you get the full upside. And you can turn it into cash or have them ship you the metal anytime. And so that has a lot of benefit to it. That's my favorite way to do precious metals investing. That's how I'm putting most of my capital into it. Again, if you sign up through the link in the video description, or you just call them and tell them that Samuel Smith referred you, you only have to sign up with a $5,000 initial investment. Otherwise, it's like a $30,000 initial investment. And then you can just dollar cost average in with very low $50, $100 a month, whatever you want to do, amounts to gradually build your gold and silver portfolio and earn yield in the process of doing it. So that's one way you can do it. I also like gold mining stocks, but you have to be opportunistic with those because they're very volatile. I like to buy low and sell high with those. You got to be really careful. Same with the streamers. And then there are gold and silver ETFs. Those are fine too. They're highly liquid ones. I recommend either if you want to do options, you can sell options against them to generate some cash flow. Of course, you cap the upside when you do that, but GLD and SLV are good for those because of the high liquidity, low options, bid-ask spreads. Or if you're just going to do a buy and hold, go with like GLDM and SIVR. Those are the lowest cost ones. If you want a mixed one, a CEF that's actually ticker symbol CEF. It's by Sprott. That's a good option as well that you can do. So that's another great way to go about it. Okay, but bottom line is even with the monetary metals, we're only getting that 4%, maybe a little less if you factor in some miners and some ETFs. And so I'm falling behind there. So how am I going to offset that? Well, a good way to offset it is with some debt and fixed income type investments. And here you can get creative. I think the BDC space is fine. You're going to have some cuts there because of their exposure to volatility and short-term interest rates, but they come with such a high margin of safety already in terms of the yield that's a good way to go. I just made a video the other day about Morgan Stanley direct lending. I think that's a great option. Blackstone secured lending is very similar, more expensive, but if you like the storied name, that's great. Aris Capital Corporation, Main Street Capital, Capital Southwest Corporation, Hercules Capital, 6th Street Lending. Those are all big name BDCs. They're not cheap, but they get you that high yield as a retiree, and some of them have very impressive dividend and even total return track records. So that's one way you can get a high yield, high single digit to low double digit yield with those. Additionally, there's a preferred ETF. It's ticker symbol PFFA. It's actively managed. It yields about 9% right now, and it pays monthly. It's been growing its dividend the past few years. It's done an excellent job of outperforming the broader REIT space. So that's another option you can do. Of course, they do use a little bit of leverage, so it's not low risk, but for a part of that 10% allocation, not a bad option. Another one that I like is a ground floor, and that's another private platform similar to monetary metals. And what you're doing there is you're investing in these loans that yield between 10 and 15%. They also have it's like a flywheel portfolio option that you can do that they automatically allocate across a very broad array of loans. And regardless whether you pick your own loans or you do their flywheel, I highly recommend diversifying broadly because individual loans, they're not low risk loans. They are backed by real estate. And so they do have a degree of physical security where even if the loan defaults, you usually I've always gotten at least some recovery, a pretty good amount of recovery. So if you diversify over a lot of loans, you're setting yourself up based on their own stats for about a 10% annualized return. And that's all in the form of cash flow. And you get regular cash flow if you diversify across a lot of loans, like through their flywheel portfolio. And so that could be a great source of regular passive income that's not exposed to public markets. And so even in that case, like if the market crashes, you can recycle some capital out of there as it comes to you being paid back to buy stocks when they're cheap. And then when the stock market is looking expensive, you can put more of your extra capital into ground floor notes, and you can rinse and repeat and recycle the capital opportunistically between the two. That's something I've done over the years, and it's served me pretty well. You're getting that nice baseline return. In fact, if you sign up through the link in the video description, you'll get $100 free as a starting gift to get your portfolio started. So please be sure to take advantage of that. And then when it comes to the next 10% bucket, so we have SCHD 25%, midstream infrastructure 25%. We've got gold at 10%. We've got different forms of debt and fixed income at 10%. That gets us up to 70. So we still have 3 more buckets. So what are these last 3 buckets? Well, REITs are going to be 10%. Infrastructure is going to be another 10%. And then mega cap tech is going to be another 10%. And so what am I going to do with these 3 10%? Well, I'll start with mega cap tech. Why mega cap tech? That's not a dividend sector. Sure, it's not, but these are the biggest most powerful companies in the world. They're not included in SCHD, and so otherwise you're not going to get any exposure to them. And so you can invest in them through different means. It depends on how big your portfolio is. But again, if you're targeting that 6% yield, so far we're at about a 6% weighted average yield because the midstream combines with SCHD for about a 6% weighted average. The gold, low single digits. Fixed income is going to get you high single digits to even low double digits. That averages out to about 6%. So now we got to average 6% over these last three. So for mega cap tech, if you have 10% allocated there, I'd probably put half of it either in individual mega cap tech names that you have high conviction in, or just buy a low cost fund like SCHD, and that gives you nice diversified exposure to growth tech stocks at a very low expense ratio. Then put the other half of that, so another 5%, in a covered call mega cap tech focused ETF. Now I've done some videos in the past warning against these, and I still stand by that. But for an income focused portfolio, for a small allocation to give you some diversification, I think it can make some sense. So if you have like JPQ, QQQI, or something like that, that can combine with the low yielding SCHG and get you to about that 6% yield. And so that's how you can handle that. Okay, so then finally the last two, REITs. What do you do with REITs? Well, you can either buy like RQY or RQF, which are some Cohen and Steers funds that give you that 6% plus yield, and you can just wipe your hands and say, I'm done. Or you can invest in something like Realty Income, WP Carey, NNN REIT, and maybe go up a little bit like with Easterly Government Properties, which I actually think is a lot lower risk than people think it is. If you look at its current fundamentals and its forward outlook, it's actually quite low risk, and it offers a yield of over 8% versus, you're just looking backwards. You can also supplement with a REIT preferred ETF like PFFR, or even individual REIT preferreds like the Gladstone Farmland preferreds like LANDP, LNDO, LANDM. That can also get you a higher yield, and average it all out, that'll get you a 6% plus yield. So you can do some or all of those put together. And then finally with infrastructure, you can make it real easy. You can just buy the Reeves Utility Income CEF. It's got about a 6% yield, paid monthly, excellent management, phenomenal track record of beating broader utility space and infrastructure space, and it has some of the leading AI infrastructure plays in there. You can just call it a day there. Or if you want to pursue maybe a little bit even higher total return potential, maybe buy some individual infrastructure names like Brookfield Infrastructure Partners, Brookfield Renewable Partners, maybe even some alternative asset manager names, and you can still get around a 6% yield if you put those all together and diversify. So there you have it. There's my a model retirement portfolio. A lot of those names I own, not all of them, but a lot of them I do, and if I were to retire, that's how my thinking would be framed. I might take a slightly different approach just depending on the situation and the exact timing of things and what my circumstances were, but that's how I would think about it philosophically, in some names that fit in there. Now, this video's gotten really long, but I'll sign off here. But thank you very much. Again, if you like this video, give it a like, subscribe to my channel to get more like this. See you next time.